I'm Maggie Williams, editor of Engaged Investor magazine. Welcome to the second of our Trustee Masterclass live videos. In this instalment, we're going to investigate some of the ideas behind alternative investments. I'm here with Kyle Mallen, Director of Blackrock Alternative Investors. I started off by asking Kyle why trustees should invest in alternatives in the current economic climate.
So before getting into the why, maybe I can just cover the what. What do we mean when we talk about alternative investments? Alternatives can be explained by two closely related definitions. The first of that being that the returns are generally not related to exchange tradable instruments. The second is that the factors which drive the returns are often not very easy to identify, such as manager's alpha skill or the illiquidity premium. Alternatives can also be broken down into two broad categories: your non-traditional beta products and your alpha products. In the non-traditional space, you have funds such as real estate products or commodities, and on the alpha side, you have private equity or hedge fund products. And within each of those, you have a number of underlying strategies which provide investors exposure to various opportunities in the marketplace and market dislocations. Coming on to the why are alternatives such a compelling opportunity set in the current environment, maybe I can just touch on what is actually happening in the current environment. It certainly is one where institutional investors are facing a number of common challenges. Investors are very, very focused on liquidity, which means that there's been a lot of compression in the liquid asset space. Due to equity market volatility or just general market volatility, there's been a reduction in the appetite for risk assets. Investors have also been concerned with inflation and the potential rising of interest rates. And in a market where yields have been extremely low over the recent period, investors are really struggling to gain positive returns. And with the threat of inflation on the short side of the curve, a lot of the yields are actually in the negative space. So in order to understand how alternatives can address all these issues that institutional investors are facing, typically alternatives have had a very low correlation to traditional investments. So what this means is, broadly speaking, they allow investors to either reduce or diversify their risk. Alternatives also have the capability of enhancing returns. They can help with hedging or protection against inflation or the potential of rising interest rates. And products like hedge funds have the ability to actually limit your downside while at the same time participate in the upside.
And are some asset classes better suited than others to the current economic environment?
We're not saying that any one particular investment in alternatives can address all the issues that I mentioned earlier, but what we believe is a broadly diversified portfolio in alternatives is what is needed. If you were to actually dig a little deeper and get down to the different asset classes, yes, there are certain assets which address some of the concerns that investors currently face. So for instance, I mentioned hedge funds. They have the ability to protect investors on the downside. But of course, investors still want to participate in that upside. You obviously need to be very aware of the actual strategy that you're invested in, and you have to understand that thoroughly, the risks that are involved and how appropriate that is for your portfolio. On the inflation hedging side, one would look to real assets such as real estate, some commodity products, and then even in the infrastructure space to potentially provide a partial hedge against inflation. And I already mentioned that in terms of in terms of enhancing your returns, you would look to something that provides alpha, like hedge funds or private equity products. In the current market, we are extremely excited about a number of opportunities and alternatives. Particularly in the hedge fund space, there's been a drastic reduction in the proprietary trading desks in response to regulations such as the Volcker Rule. What this means is the market dislocations and inefficiencies are much more prevalent and pronounced than they were in the past. I mentioned infrastructure earlier. Something that we are seeing as a great opportunity right now in the infrastructure space is renewable power. Renewable power is investing directly into projects such as solar farms or wind farms, and then selling that electricity onto a utility company. The agreement between the electricity provider and the utility company is very often linked to inflation. So not only is that providing bond-like income streams to the investor, but also providing a potential inflation hedge.
So what is an appropriate allocation to alternatives in a portfolio, and what should they replace?
Each and every single client's portfolio is very different to one another, which means that each investor faces a number of different challenges and concerns. We would encourage pension funds to partner with asset managers to help better understand exactly what these challenges are. And whenever a client is looking to reallocate away from a certain asset class to another, we would encourage them to go straight back to the very, very simple portfolio construction tools which they would use. So one would want to look at exactly how that reallocation would affect the rest of the portfolio. They would need to look at the exact risk and return objectives of the fund. They would need to look at the liquidity objectives of the fund. And taking all of this into account, you would then look to create a specific solution for your portfolio. And like I said a little earlier, it's not a case of just investing in one alternative product. It really is a better approach to look at a diversified portfolio of alternatives. We certainly are seeing an increased focus on alternatives in the pension fund space. A survey by Russell Investments envisaged a growth of 60% in allocation to alternatives between 2009 and 2012. We're seeing pension funds reallocate away from both equities and bonds to fund their alternatives allocations. And in the UK, for example, UK investors typically have a fairly large weighting to equity products. And so they are moving away from their equity products and investing into alternatives using those assets.
And what techniques can trustees use to make sure that they get the best from the alternatives in their portfolio?
I think there really is one basic technique that needs to be used, and that's to build a very, very strong, robust framework. That framework requires fundamental judgment and quantitative analysis. It requires the investor to look at the asset on a standalone basis and then look at that asset and how it interacts with the rest of the portfolio. The four sort of cornerstones of that framework would be organizational issues, so things like fiduciary responsibility and alignment of interests, the manager's skill and experience. You would then look at operational areas such as does that manager have a dedicated and independent risk management function? Do they have a robust operations platform? Do they have the support from legal and compliance? And do they have strong counterparty relationships? You would also then look at the investment side. So areas to focus on, of course, being return and risk objectives, your leverage, your transparency, and are the fees that are being charged appropriate for this investment? And there's some other areas to look at as well, such as regulation. And what this does, this framework, is it provides the tools for investors to look at and assess their current holdings, their future potential holdings, and to look at this in a portfolio context. And we as a manager are looking to partner with our clients to help them build this framework, assess and understand the concerns and challenges that they face, and create solutions that directly address these.